Hello, I'm Peter Switzer. Welcome to the program that helps you make the absolute most of your money. On Switzer Tonight, we'll see what moved the markets today and get some analysis of reporting season with RBS Morgan's Marcel von Pfeiffer. Roger Montgomery's coming in to explain how to value companies and not the way the boffins do it. This is a method all of us can understand. Back to basics. Throw away the spreadsheets and complicated formulas and let Roger Montgomery show you how to value a company the easy way. Over the last few weeks, we've been absolutely bombarded, as we are every 6 months, with company reporting lingo. We get EPS, EBITDA, NPAT, the list goes on. But if you're not a mathematical boffin, how do you figure out what it really means? How do you know what a company is worth? And so you can figure out whether or not you want to buy it. Roger Montgomery has been on this program before to explain how he does it, but I had plenty of viewers saying it was actually too hard to grasp. So tonight, the bare bones. Company valuations for dummies. Welcome, Roger. How are you, mate?
Thanks, mate. I'm very well. Nice to be here.
Now, you know, your brilliance, I put that in inverted commas.
Thank you very much.
Is the fact you can value companies. And you've been good at it.
Thank you.
My brilliance, not inverted commas, is that I understand what people don't understand. So I'm going to play devil's advocate here.
So we're perfect.
Exactly.
It's a synergistic merger.
Exactly.
Right.
Of course, I'm smart enough to understand everything you say. But for my viewers' sake, I'm playing the dummy devil's advocate.
Okay.
Because I think I love the way you pick out companies, and I think the more we understand it, the better it's going to be for people, particularly if they're developing their own portfolios, self-managed super funds, whatever. So, what's the starting point for valuing a company?
I should say, the starting point is to know that the price that you see on the stock market isn't always right. Most people approach the stock market believing that the price is correct, and they buy. So let's say they buy shares in, I don't know, Macquarie Bank or CBA, whatever it is.
Say Telstra at $3.01.
Well, do you know, just as an aside, I was on your program a fortnight ago, and Telstra was at $3.30 or $3.27 around there, and I said to you, mate, it's worth $3. Yeah. Where is it today? $3.
$3.01. You missed by one.
Well, it got down to $2.90.
And we're going to talk Telstra. A viewer question came in.
Okay, fine. So here's the thing. The price isn't always right.
Okay.
The price is often wrong. I valued Telstra when it was at $9 back in 1999 or 2000. I valued it at less than $3 then. So the reality is that the market often gets it wrong, but most people buy Telstra shares and then it goes down and they think the market knows something I don't. Well, no, it just might be that the value is a lot lower than where you bought it, so you paid the wrong price. So what I'm going to try and do now is explain to everybody who's watching your program how to get an approximate value, an estimate of the true intrinsic value of the company. Okay. Now, imagine I have a bank account, and in that bank account I've got $10 million as a special bank account because the bank has given me forever a 20% return on that bank account. So I'm going to earn 20% on $10 million.
That's the kind of bank everybody wants to be banking
but I'm the only one.
Okay, right.
I'm the only one that's been entitled to access this particular bank account. It earns 20%, and all of the earnings, all of the interest is paid out every year. So I get that every year.
Yeah. So the fixed sum runs 20. You take the $2 million.
Now, I'm going to put that account right here on the program today. I'm going to put that account up for auction. Okay? And I'm going to offer it for sale. Now, everybody can ring up and put in their bids or SMS or email or however they want to contact you, and they put in their bids for this particular account. Now, I reckon we'll get some pretty crazy prices. But what is that bank account really worth? Okay, so here's the thing. I say to myself, well, you know what? I'd be really happy, or Peter, I'm speaking for you now, you're really happy with a 10% return on your money. So I've got this bank account with 10 million in it, and it's earning 20%. And you're happy with 10%, which is half the money that's coming out. So how much is coming out every year? Well, we've got $2 million coming out in interest every year, and you want a 10% return on your money.
So I'd be happy to pay $20 million for that.
You pay $20 million. That is the intrinsic value of that account.
And we'll teach a little lesson here. What you're actually teaching also when interest rates go up and bond prices go down is
there's an inverse relationship. And in fact, when interest rates go up, the value of every asset goes down, not just bonds. Everything goes down for that reason. So the formula, the basic formula for that particular scenario is return on equity, which is our 20%, divided by our required return, and yours was 10%,
yes,
multiplied by the equity per share, and the equity was $10 million.
Yeah.
So 20% divided by 10% is 2. Multiplied by $10 million is $20 million. Yeah. That's what the account's worth. Yeah. And that's how I value pretty much every company. But that formula only applies to companies and bank accounts that pay all of their earnings out as a dividend.
So do you rule out companies then that don't pay out?
Oh no, I like them a lot.
Okay.
If a company, if that bank account, if that bank account is earning 20% and the bank let me keep my interest in there,
it rolls over
I would rather keep it in there because where else am I going to get 20%? Exactly, it's the snowball effect. So it's compounding. So a company that can retain profits, a company that can keep the profits in it and continue to get high returns, they're worth a lot more.
Okay.
And there's a slightly, look, there's a little tweak to the formula, but people have to buy the book.